Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Wednesday, 30th July. Coming up on the show, Wall Street is gearing up for a big day. Policymakers at the Federal Reserve will make their call on interest rates, and big tech is set to dominate corporate earnings. We'll have an update on how trade talks between China and the US went in Stockholm, and we'll have the details of the latest companies to warn about the cost of tariffs. So grab your coffee and let's own the morning. Well, before we look at the things you need to know before the opening bell rings, let's check in on the markets quickly. Well, US futures are trading a little bit higher on what is likely to be one of the most crucial days in the markets this year. Our first thing to know is that big tech is very much in focus today. Two of the Magnificent Seven are reporting after the closing bell, Meta and Microsoft. Microsoft has fourth quarter earnings out. CapEx and AI will be very much what investors will be looking out for. It's expected to report continued strength in its cloud business, powered by growing corporate demand for artificial intelligence. The firm is spending more, but don't forget, it recently cut 15,000 jobs. Okay, Meta has second quarter results out. Here, advertising spend looks like it will be the key driver. Watch out too for any more details on AI. Meta is expected to scale back spending on its reality labs, but increase spending on AI. The next thing you need to know before the bell rings is about tariffs again. This time, some big car brands have added to yesterday's warning from Stellantis about the cost of them to their businesses. The chief executive of Mercedes-Benz said he was expecting, quote, significantly lower full-year sales and weaker profits on the back of tariffs on cars exported from the EU to the US and sluggish China demand. Following the deal that was signed earlier this week, imports from the EU will be subject to a 15% levy. Luxury car brand Aston Martin also issued a profit warning, largely based on the trade war hit. It says it will bring forward production at the beginning of next year as it looks to swerve a worst hit from US tariffs. Japan's Nissan, as well as warning about sizable losses as it grapples with a turnaround plan, said it too was facing tariff headwinds. But its rival Toyota was much more bullish as it recorded record global sales. And the last thing you need to know before the opening bell rings is that today is interest rate day. The Fed is expected to keep rates on hold, but any clues on whether policymakers may cut in September will be very much in focus. But it seems to be becoming more and more clear that not all on the Fed board are singing from the same hymn sheet. My colleague Jennifer Schoenberger breaks it all down with Josh Lipton.
The Federal Reserve widely expected to hold interest rates steady when they conclude their meeting Wednesday afternoon, likely to spark further ire from President Trump, who has been hammering the central bank to lower rates. And while the majority of the FOMC remains in a wait-and-see mode to see what impact tariffs have on inflation, all eyes will be on whether two Federal Reserve governors, Michelle Bowman and Chris Waller, will dissent. Waller made clear ahead of the meeting that he wants to cut rates tomorrow because he thinks any inflation from tariffs will be a one-time increase he believes the Fed can look through. He's also worried that private sector job growth has stalled. Now, Bowman's similarly more concerned about the employment side of the mandate, an about-face from last fall when she was more concerned about inflation, though she said in June that she needs to see if inflation continues to be benign. And if we look at the last inflation reports, they were a bit of a gray area, so we'll see if she also dissents. If we were to get two Federal Reserve governors who dissented, that would mark the first time since December 1993. And just to add a little more color there as well, of the 61 meetings that Powell has chaired, there have been 16 dissents. Of those dissents, 14 have been from regional Fed bank presidents, while 2 have been from Fed governors, of course, not together, separate. And Josh, we've also learned that Fed Governor Adriana Kugler is not attending this policy meeting due to a personal matter. So that means there will be 11 voting members tomorrow instead of 12, one less hawk for that committee.
And
Josh.
Jen, before you go, one question, my friend. Do you think Chair Powell, Jen, opens the door to a cut in September during that press conference?
Yeah, that's the $64 million question, right, Josh? And I just want to take a step back and actually reference a comment that San Francisco Fed President Mary Daly made ahead of this policy meeting. And that is that she feels it's still too soon to make a call on inflation. But she says you can't wait forever until there is weakness in the labor market. So sort of setting up there for September. We know she's very much middle of the road. We also know that Chair Powell is a bit of a political animal, and there has been a lot of pressure from the administration on him and the rest of the FOMC to cut rates. So it will be interesting to see whether he cracks the door open to set the table for September. Remember, he has said he wants to see whether inflation remains under control through the summer months. So far, it pretty much has been. And if it's just a one-time increase in prices, he very much well could do it. We'll see.
Well, be sure to tune in to Yahoo Finance for live coverage and analysis of the Federal Reserve decision starting at 2 p.m. Eastern Time and Fed Chair Jerome Powell's news conference, which gets underway at 2:30 p.m. Okay, so for market movers, let's look at earnings once again. We start with Hershey. Revenue for Q2 has come in at $2.61 billion. The market had been expecting $2.52 billion. Meanwhile, adjusted earnings came in at $1.21 per share. The forecast had been for $1.01 per share. Shares in the pre-market are up about 0.5% there. Now, analysts who cover the chocolate maker have been growing more bearish in recent times on the stock. Despite this, the stock is up around 9% this year so far. And in fact, not so long ago, analysts at Barclays raised its price target on the stock. Okay, next up is Kraft Heinz. Revenue has just come in at $6.4 billion versus an expected $6.2 billion. It's roughly around a 3% decline. Earnings per share came in at 69 cents per share against an analyst expectations of 64 cents per share. Shares, as you can see, up over 1% in pre-market. Analysts who cover the package maker basically have been, pretty downbeat on the stock so far because it's facing headwinds in its volumes for performance and has been grappling with evolving consumer behavior and, of course, macroeconomic pressures like tariffs and inflation. Okay, let's move on to Harley-Davidson. Revenue there has come in at $2.61 billion against a forecast of $2.52 billion. Earnings per share of Revenue came in at $1.31 billion versus an expectation of $1.36 billion. Sorry about that. And earnings per share came in at 88 cents per share, but what they have actually said is that tariffs are having a big impact. They actually put the cost in at $13 million. And that's really complicated the company's global supply chain and increased cost, as we can see there. Okay, the final one to look at is Etsy. Revenue for the e-commerce giant has come in at $672.2 million against an expectation of $646 million. But earnings per share came in at just 25 cents against 49 cents expected. But shares there have jumped over 4% in the pre-market. It's worth remembering that Etsy shares have been under pressure since the pandemic, but tariffs on imported goods could renew interest in Etsy's US-made, handmade offerings and give the company a second life. Okay, it's time now for a short break. When we return, we'll be taking a closer look at the S&P 500. Stick with us on Market Sunrise. Welcome back. Now, with big tech in focus today, we take a closer look at the S&P 500. Could we be at a moment of truth once all the Mag 7 have reported? Their impact on the S&P 500 is pretty large and has seen the index hit numerous record highs in recent days. But is the bubble about to burst? Well, friend of the show, Josh Schaefer, takes a closer look with Julie Hyman.
You asked some people yes, you asked some people no, right? So I brought 3 charts with me today, and we can sort of defend both cases. But I think that was a key debate within our book that has over 35 charts is, are we sort of at a top at this point after we've had this big rally? Are stocks too expensive? So this is a chart from Barry Bannister. What he's looking at here is, as it says there, the enterprise valuation relative to economic profit, essentially how much am I paying for stocks based on what the companies are actually producing in some ways. And you can see here, it has not been this overvalued as Bannister estimates it since 2000, 1999. What is that? Of course, the dot-com bubble, right? And so that is kind of the classic comparison I think we're seeing right now is the question when you think about this AI-led rally is, okay, is it a dot-com bubble style thing? And at least by this metric, you could at least argue from a valuation perspective, it's looking a little similar.
I mean, Barry is a noted bear on the market. I mean, there are those who would say markets don't just roll over because of valuation. Something has to happen, right?
Well, and I think you see that here too, right? Look at where we call it overvalued in early 2000. That's a 3-year period that we sat there, right? And so you could also point out, yes, we've started to creep higher here, but to your point, Julie, the question would be what actually makes this matter?
Right.
And you need some sort of catalyst, whether that would be economic slowing, some impact from the tariffs, et cetera. I also thought this chart from Max Grinikoff at UBS was interesting. So you're looking at the discount rate proxy versus the S&P 500 forward price to earnings ratio. This would be kind of a traditional valuation metric, right? And back to Barry's chart, if you looked at the S&P 500 forward PE, it would kind of look similar too. We're definitely in elevated levels here, but what this gap is sort of telling us that Max explained in his commentary is essentially investors are paying a lot for AI exceptionalism. And the question is, does that sort of come through? There is a world where this gap is worth paying more for if I'm an investor, right, and stocks being more expensive. But there is also a world, as we keep talking about during earnings season, where that doesn't come true, right? And then you're perhaps overpaying for stocks at that level.
Okay, and what's the third one?
Our final chart, I love this chart from Todd Stone over at Strategas. So what he's looking at here is the S&P 500 and essentially making the argument that it's less defensive than it used to be.
Well, and what I love about this chart too is it's the inverse of what we tend to talk about, which is that, oh, the S&P 500 is so heavily weighted to tech. Okay, so if it's so heavily weighted to tech, what is it less weighted to?
And it's less weighted to consumer staples, energy, healthcare, and utilities. So you can see that used to be 40% of the index going back about 30 years ago. Now, from a market cap weighting perspective, it's about 22%. And what I think this also tells us in this valuation discussion, normally you would pay a higher valuation for tech stocks or a tech-heavy index, right? Well, the S&P 500 is a tech-heavy index now. So Savita Subramanian in our chart book sort of made that point, that maybe it's worth paying up more and having it be quote-unquote more expensive if you're getting a different product or a different index than you were getting 30
Well, and you could also make the argument that defensive isn't what it used to be, right? It doesn't, you know, there were some who would argue that even tech has defensive characteristics and things like healthcare are perhaps less defensive than they used to be in the past. So these things are all kind of scrambled over time, it feels like.
They are. There's a lot of debate, always is.
Really interesting analysis there from Josh and Julie. It's time for another short break, but stay with us for trending tickers and an update on where we stand on the China-US trade talks. Be right back. Okay, welcome back to Market Sunrise. Now it's time for some trending tickers. First trending ticker this morning, well, it's Starbucks, a stock that's getting a kick from its latest earnings report that came in after the closing bell. Shares rose 4.5% in pre-market, as you can see there, after the coffee shop chain's CEO, Brian Niccol, said the company's turnaround is, quote, ahead of schedule. The rise in share price came despite Starbucks reporting some pretty underwhelming numbers. Adjusted earnings per share came in at 50 cents, which was below the Bloomberg consensus estimate of 65 cents. And profits, well, they tumbled much more than anticipated in the quarter, as costs of this big turnaround plan piled up. Net income plunged by 47% to $557 million, much more than the expected 30% year-on-year decline. Starbucks has been hiring more baristas and implementing higher hospitality standards to improve customer experience. And yet, the CEO said, quote, "We fixed a lot, and in 2026, we will unleash a wave of innovation to build a better Starbucks experience and a better business." Okay, now let's move on to a big name in pharma. The producer of Wegovy and Ozempic, Novo Nordisk. It keeps falling after it announced a reshuffling at the top yesterday. As you can see here, the Danish drug maker is down nearly 3.5% after its New York listed shares collapsed by more than 21% yesterday. Since yesterday, just doing a quick calculation, it's lost more than $90 billion in market cap. Think about this, that's the equivalent of more than 20% of Denmark's GDP that got wiped out, as Novo Nordisk loses ground to its main competitor, Eli Lilly, especially in the US. And you can see here that Eli Lilly shares have been doing much better in recent months. Novo Nordisk has slashed its sales and profit forecast. The company also said it now expects operating profit growth of 10 to 16%, down from its previous estimate of 16 to 24%. The company said it was mostly because of competition, and in a separate statement it announced that Mazia Mike Dustar has been appointed as president and CEO. In short, even if revenue at Novo continues to soar, analysts say the pendulum has swung from wild optimism at 39 times earnings to rampant pessimism now. And now Adidas, it's our third trending ticker and is another company that's facing big challenges from tariffs. And you can see here that's reflected in earnings and in its stock price. It's also going to be reflected in the price of your sneakers too. Adidas, which produces a big chunk of its products in Asia, has warned that US tariffs will cost it an additional $200 million, and it has no choice but to raise prices for US consumers. The German sportswear giant admitted that it still doesn't know exactly what impact this will have on consumer demand. But this chart is pretty telling. Its shares are down about 30% in 6 months. The maker of the popular Samba and Gazelle sneakers produces a lot of its goods in Vietnam and Indonesia, and it's also trying to keep up with an increasingly competitive market. Recent studies indicate that many consumers right now are more eager to get performance equipment when they look for sportswear, looking for value beyond fashion and style. And chasing those trends isn't easy for many companies out there during this time of tariff uncertainty. The CEO of Procter & Gamble explained some of those challenges to our very own Brian Sozzi on Opening Bid here on Yahoo Finance.
We are seeing modest trade down within our branded portfolio. So within the different Tide offerings, there are some that are more premium than others, and we are seeing some trade down there. We're also seeing some trade down to brands that you mentioned, like Gain. We are not seeing any trade down as of yet to private label. Private label shares in both North America and Europe are down if you look at the last 12 months or even more recent periods. So consumers continue to understand the value that's contributed by performance. Remember, when we did that big portfolio consolidation that you talked about, there were two strategic objectives associated with that. One is to concentrate our portfolio in categories that were used daily or even more than once a day by consumers. The second was to concentrate our portfolio into categories where performance drives brand choice. And that's held up extraordinarily well and puts us in a much better place as we move forward.
Okay, before we close, there's one more giant story you need to know, and that's the US-China trade negotiations. Treasury Secretary Scott Bessent is set to brief President Trump today after 2 days of talks in Stockholm. The president said he may or may not approve an extension of the trade truce between the world's two largest economies. The world of business is definitely watching closely, as many companies around the world have lots of exposure to both markets. Just today, we see shares of the banking giant HSBC stumbling after it reported that its Chinese business is facing serious headwinds, particularly due to the real estate market in Hong Kong. Luxury is another sector that's holding its breath. Hermes posted impressive sales growth of 9%, but if you take a closer look, sales in China plummeted and makes up 45% of the revenue of the maker of the Birkin bag. So the stocks, as you can see here, are down today. So back to trade negotiations. Where do things stand exactly between the US and China? Reuters reporter David Lauder followed the talks in Stockholm. He gave a recap to Yahoo Finance.
The picture that's kind of emerging here is that the outlines of a deal were agreed at these talks to extend the tariff pause for another 90 days, which would apply to the tariff rates that we had back in April, as well as the flow of critical minerals that was agreed back in May and June in Geneva and London. So the key, as you mentioned, is that the president has to sign off on this, that essentially Greer and Bessent did not have the authority to actually finalize it. So they have to take it back to President Trump. Now, of course, they were making positive noises about the meeting, that essentially they would give him a positive report that would likely result in his decision to go ahead with a pause. But, that's not it. In Trump world, you never know until you finally know, until it comes out of his mouth. So, they discussed a lot of other issues which we can get into, but that's basically the pause is teed up. President Trump just has to bring it over the finish line, and that's what tomorrow is in the Oval Office.
So let's say, David, I'm just curious. So let's say Trump does give that green light. Then what, David? Then you just, okay, we skip ahead in 90 days. We get the band back together again.
Yeah, there was allusion to another meeting in 90 days. Who knows what city that's going to be in? Whether it'll be in neutral territory. There's also, discussions that many of us have reported about a potential meeting between Trump and Xi later this year around the time of the APEC conference in South Korea, end of October-ish. So those arrangements were not discussed specifically at these meetings, but that's kind of like lurking in the background of all this.
And we'll keep a close eye on those negotiations here on Yahoo Finance. Okay, before we go, let's take a look at the markets. Well, global stocks struggle for clear direction on Wednesday ahead of the Federal Reserve's policy announcement later today, with investors cautious after 2 days of trade talks between the US and China concluded without any major breakthroughs, as we heard just now. In Asia, the Hang Seng clearly one of the big losers there in Hong Kong, probably the biggest reaction to the fact that there seems to be no clear path in the trade talks between the world's two largest economies. The Nikkei there is started the day on the front foot, but has petered out slowly a little bit. In Europe, stocks are fairly flat in the main. The earnings that beat expectations were balanced out by those that missed forecasts. Data out just a short time ago showed that the Eurozone economy eked out a better than expected 0.1% growth in the second quarter compared to the previous 3-month stretch. European bond yields were little changed after that data release. And moving on to the US, and as you can see, it's a sea of green. Remember that before the Fed decision and those big corporate earnings, traders will be monitoring economic data on private payrolls, GDP and pending home sales, which are due later this morning. Treasury yields and the dollar are also little changed as the market anticipated the Fed will keep rates on hold despite pressure, as we know, from the White House to lower borrowing costs. Okay, that's it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up at 9 a.m. Eastern, join Julie Hyman ahead of the market open on Morning Brief. And of course, stay tuned for our special coverage of the Fed decision at 2 p.m. Eastern Time and that press conference with Jay Powell at 2:30 p.m. I'm Ramzan Karmali. Go own the morning.